Today's topic is about debt. Got a lot of tabs open today, so hopefully this works smoothly. But today's topic is about debt, about how to use debt strategically to build wealth. Now, it's a very contentious subject amongst the finance community. However, factually, what cannot be argued is that debt is primarily the main driver of wealth, especially in the higher end of the wealth community. But it is dependent on whether you're on the bad end of that debt or the good end of that debt. So we'll start today talking about the different types of debt that can be used for wealth. We're not going to be talking about car debt. We're going to be talking about own home debt. We're not going to be talking about all the shitty debt that doesn't actually make any sense. We're talking about debt, simply debt using for investment purposes. Also known as deductible debt, also known as good debt, also known as leveraging or gearing. So when I refer to leveraging, like think of just leveraging something, is magnifying the money that you're using to invest through debt. That's why we call it leverage. Gearing, think of it geared up, right? So leverage, gearing, debt, deductible debt, good debt, all the same shit. Using debt to invest and build wealth. Now, there is a quote that everyone is very familiar with. I actually don't know who says it, but how they say, compounding interest is the eighth wonder of the world. Those who understand it earn it. Those who don't pay it. It's very true in this scenario, and that can be aligned very quickly, very aligned alongside debt. Those who understand debt can make substantial wealth from it. Those who don't, it is really important here. Debt isn't talked about enough in a lot of investments, and a lot of these get rich quick or social media investors. They talk about assets like crypto or property, day trading, all these ones that get rich quick. The majority of those aren't investing in anything crazy. It's the leverage, the debt they're using to do it. And that's what I really bugs me about these people. They say, I love property, I love shares, I love crypto. No, you don't. You fucking love debt because that's what's actually generating the returns. Now, debt is scary for a lot of people. And it's one of those things that, because it's a magnifier, and because we've been in such a good community, before we start, I got a question for everyone on the live, which is no, but for those watching it back, I think I'm going to get that tooth replaced with a gold one, so it might smile straight. What do you reckon? Comment below later on whether you reckon I should get a gold tooth there or not. But anyway, I digress. So, what we're talking about when we look at debt is it's a magnification of returns. But because we've been in such a good, a positive bull run for so long with minor setbacks, no one really has faced the downsides of debt since the GFC. And so a lot of my clients, a lot of our generation, we don't see that. We've never felt that. So we're very oblivious and ignorant to it. A lot of the old generation were very debt adverse, with those who got absolutely smashed thanks to debt during that time. Hence why there's a disparity between them and us. So it's important that you understand that debt isn't always bad. Debt can be a substantial wealth builder. It can be good when done properly, but it needs to be done properly, because should it go bad, it can end your entire plan, right? If done over leveraged, over debted, with no backup plan, it can absolutely melt you. So, what are some ways? Well, I want to find this quote first. Hang on. Let me tell you about this quote.
So we've gone for a cancel replace. Premium rates quoted.
Oh, well, so I can find the one I'm talking about.
So that's for a life on TPD policy. Let's see.
I can't find it. Anyway. So we've got to understand the different types of ways to use debt to invest. Now, at the end of this session or midway through, we'll jump on software that I love every time, and we'll go through that in substantial detail. We'll put some scenarios in place. But right now, let's talk about the different types of debt. Well, I'm going to share a page with you. If I can find it. Here we go.
Kenny Van Ward is actually.
So we love the team over at Beta Shares. A lot of you guys are invested with some of their ETFs, some of their funds. But here is a great page to ask about geared, right, or leverage. They got a great little summary on the different types of leverage you can use. We're going to cover off today on investment loans, margin loans, and internally geared funds. They're the main three. Options, futures, structured products, and the stocks on the run. So a little bit more niche. But the majority of people have access to these ones. So
Yeah,
have access to these ones. So we're going to go through those today. So let's start with the first one. So your most common type of leverage is investment loan, generally used for either business purposes or property. We're going to stick to property today. We're not going to talk about business. Talk about property. So property is the most common type of leverage. I don't know why people think, people are like, oh, borrowing money to invest in shares is risky, yet they willingly do it for property because it's now seen as the only way to buy property because it's so expensive. But if you think about it, when we're buying an investment property, let's say we start with $100,000, 100 grand,
I'm gonna forward you.
we can borrow and roughly a 9-to-1 ratio. So against property, most banks will lend us between 80 to 90%, which is crazy when you think about it. It means they will give us 9 times our money to invest on something that we then control. So what does that mean? Well, when we take that investment loan against the property, and we'll use a scenario, say we're buying $1 million property with $100,000 deposit. Very hard to do in today's world, but let's say we're doing that. You own $100,000 of that property. Don't get it twisted. You don't own the whole property. You control $1 million worth of assets, but you only own $100,000. And this is your loan to value ratio or your equity per se. When markets are good, leveraging is fantastic. So for example, let's just assume property does 10% a year. Right? Let's just assume property does 10% a year. If I have a property that is worth $1 million, I'm controlling, and that property does 10%, even though I only own $100,000 of that property. If it does 10% on $1 million, it makes $100,000, which is technically 100% return on my money. So the power of leverage, right? Well, the power of leverage is that on a small investment, I can get a massive return. Now, the property didn't return 100%. The property returned 10%. Don't get this twisted. This is what people forget so often. They say, doubles every 10 years, 15, whatever. It's not. Usually people's investment doubles, not the actual property value. Because the property's only gone up by 10%. It's only made $100,000. Because you've only invested $100,000, therefore, you have doubled your investment. However, you've also got to factor in the cost of the debt, right? So the holding of that property. And this is where a lot of people forego the information. Interest component, how much you had to pay over that year. Let's say $900,000. What's that?
So it's definitely his best interest to retain what he's got. I just know with the cancel replace.
We've paid $54,000 in interest that year, which is deductible. Comes off a tax bill, which is great. So realistically, you probably paid like 30. So we've really only made, other than the holding costs and everything like that, probably made 70,000. But let's not get into semantics, right? Let's just keep using the same scenarios that the online gurus use. So we've doubled our money. 12 months, we've leveraged, put down $100,000. We're controlling $1 million asset, made $100,000. That's great. It's fantastic. That's what's beautiful about leverage. But what's the downside? Well, what if that property lost 10%? Which they can, they do. That property loses 10%. It's lost 100 grand, meaning that we've had 100% loss, right? So this magnification of debt works on both ends. It works on the positive side, it also works on the negative side. Now you can see if somebody doesn't have their shit together and they're just leveraging willy-nilly, and you continue to lose 100% of your money, at some point you can't fund that anymore. Right? At some point you need to sell and get out and probably left with the debt with no asset attached. And this is what you've got to be careful of when we're leveraging. This is why I've got to be important, because the biggest risk, especially when you're on a higher income, biggest risk of not leveraging is paying the taxman every dollar you're required to pay without minimizing that. However, when we use debt, we can access some of that money to help us fund investments. And that's the benefit, right? So as long as you do safe leverage, safe borrow, then in that scenario, it's actually reducing some level of risk. But when people tilt too far, they get a bit greedy, a bit cocky, and they leverage too hard. Well, then that risk can completely undo them, and we've got to be cautious of that. That's the first type of leverage. First type of leverage against property, investment loans. If you want to see what these guys say about it. Mortgages are secured over property or the assets that are the subject of the investment. Many Australians choose to negatively gear their investments into the property market, meaning that the interest cost of a loan and other costs associated with investment exceed the level of income generated by the property. So that's just their summary, right? So the investment lending, mostly into property, most common way of leverage in Australia. Then we've got a little unknown one that people don't really, some people do, but a lot of people don't. A lot of people think, we have the old shares versus property debate. Now, I showed you this in the other week. I showed you that shares outperforms property every day of the week. Every single day of the week, shares outperforms property for the last 30 to 50 years. It's not property that people love. It's leverage, because when we're investing in property, the bank will give us 9 to 1, sometimes 95 to 1. The bank will give us 9 to 1. When we're investing in shares, they'll generally give us, when it's not secured against property, so what a margin loan is, where you're securing against the shares, against the asset, they'll generally give us 1 to 1, the 50-50. So this is what makes it hard. Now, it is technically speaking, it is a lower level of risk. A lower level of risk because you're leveraging less, right? But this is where the return of leverage comes in.
For sure. Forgive me, I'm just going to eat a snack as we talk.
Oh, and there's Baroccans today. Big night? No, big day.
Anything else that we discuss?
Again, I digress. So, if we have a look at, I'll get my calculator out. Now, let's run that scenario run before, right? So, if I have $100,000 and I was to invest that $100,000 max leverage against its property, I get $1 million asset. So we've already talked about that $1 million asset, and I'm giving it some buffer room here because it's not really 100% return after you take costs into account. But let's just pretend. Then I get 100% return on my initial investment off a 10% return on the asset. Now, if shares and property do the exact same, they're very similar in performance. They do similar performance over time. But when I have $100,000 and I want to invest in shares, the bank will only give me another 100, so just 1 to 1, right? Well, it's obviously a lot harder for a $200,000 asset pool to outperform a $1 million asset pool, regardless of the return, right? So if that $200,000 share portfolio does 10%, I make 20 grand. Now, given there's no holding costs, it's net, it's good return. But I have to perform at 5 times the return, right? I have to perform at 5 times the return just to be able to match the same amount of money that I made in the property leverage scenario, right? So that property performing at 10% to get me that $100,000 return, I would need my portfolio to operate at 50% to get the same return, right? And so this is where the risk versus reward ratio weighs up, because to get 50% return in shares or in any asset, you're requiring high risk. So what leverage does, leverage allows you to chase a lower return for a bigger outcome than taking more risk on the other side, right? Like as in the asset pool side. So there's risk on both scenarios to achieve the same outcome. And this is what's pretty misunderstood about that. A lot of people think, sorry, I'm scratching something bit me. A lot of people think, borrowing is risky. Well, it is, but if you're chasing a level of return, you can borrow money. I want you to do the calculations around the holding costs and all that stuff, and actually borrow money into a safer portfolio to generate the same outcome as not borrowing money and taking a full risky approach, remembering that anything that's going to perform 50% could also do negative 50 to 100 as well. Whereas we could borrow and put into something just chasing 10%, meaning the downside would only be 10%. Now, the leverage increases the risk, but the actual asset can be safer. And that's something that's always missed when people are thinking about that. So you either have less leverage and take a higher risk portfolio, or you have more leverage and take a lower risk portfolio. That's sort of how you can adjust and decide. The added benefit of the leverage, though, is that the downside's got cost involved, but the upside is that you can use your tax benefits and stuff like that. So it's really important to understand those two things. So a margin loan, what a margin loan is, so investment loan against property, you're 9-to-1. What a margin loan is you essentially the bank or the product. So, the main one that's used around, you can use CBA, NAB, equity portfolio, but the big ones, leveraged equities. Haven't used them in a while. I don't really like margin loans. I think they're a bit limited, but what will happen is you put your money in, and just like when the bank will secure their loan against the property, you can secure the loan against the shares or the cash or whatever asset you're going to leverage against, but it's at a lower ratio, a 1-to-1 ratio. Now, the difference is that in a margin loan, when the LVR drops below a certain percentage, which would usually be like a 70% LVR of that 50%. So when it drops under that LVR, they will do what they call a margin call, which means you either need to sell some assets to to pay down the debt, or you need to put more money in. And that's why a lot of people don't, is it's whereas with property, the asset can fall unless it really fell to dire straits. Very unlikely that the bank's going to come and call on their money. But in the property sense, if it was to drop and never return, you have to sell, then you still owe that debt, right? Whereas in a margin loan, when they do a margin call, it's either sell down the asset and clear the debt, or put more money in to increase the LVR. And that's the risk you got to play with it, right? But there is a way that you can lend money if you don't have the capacity to borrow or you don't want more property. You can do it with shares, and the margin loan is a great way to do that. Obviously with its own risk involved. But usually we look at a 1-to-1 ratio. Now, when I say 1-to-1, like you can borrow, I think, up to 70%. But if the LVR goes over 70, that's where you have to dip in the extra money. So we like to do LVRs at 50-50 with margin loans, just to give us that buffer. It's pretty standard practice. But yeah, you don't want to start with 70% LVR and then be at full tilt from the get-go. But that's what it is. You start with 1-to-1, they'll comfortably borrow 1-to-1, but if the LVR pushes up over 70, then they'll ask you to sell some shares or to put extra money in. So that's our two ways, right? That's our two major ways where you're actually the borrowing, you're taking the credit facility and you're risking it against your borrowing capacity to then go in against the asset. Then there's the last way, which I'm going to be careful saying it's the safest way. It's probably the easiest way. And they're getting a bit more traction thanks to a couple of advisors on LinkedIn and stuff who are pushing them. But these are called internally geared funds. So when you invest in a managed fund, an ETF, exchange traded fund, ETFs being, we've talked about this in the couple of last ones, but the ETF being a bunch of stocks held within a fund that you invest in that and you own all the stocks, and that way you don't have to manage it. A managed fund being a trust that's a listed trust that you put money in and you own units in the trust that is then invested in stocks or whatever. The way these work is you don't actually have to borrow any money. So you don't have to go to the bank, and it doesn't affect your credit score. You don't have to have any capacity. You're just buying ETFs or stocks or funds, whatever you want to call them, that are in there on the stock market that already have lending built into the fund. So we can have a look at a couple here.
Can you contact them?
Let's go to.
Maybe let's just see.
So the Australian Equity Fund. So you have a look and you go in there. So what happens is the fund is actually borrowing, and they build the cost of that borrowing into the cost of the fund, right? They'll change the ratio and everything like that, but you can read through here and it'll tell you. So, for example, the gearing ratio will generally vary between 50 and 65% in any given day. The fund exposure anticipated to vary between 200 and 286% of the net asset base in any given day. You can go down and have a look how much is in there. See how this is quite high. So, if we were to look at the normal fund, it'd probably be like 0.2, 0.3. So, you're paying a little bit more to cover the cost of the gearing inside that fund. And then we can see
I really appreciate how quickly
here. So gearing range, so current gearing exposure, 57.3%. So it's a 2.34 multiple. They usually run between 2 and 3 times. So we've got 57% of that fund, so over half of that fund is debt, right? Is borrowed monies, which is pretty big. And if we have a look, we can see that comparative from a return perspective, right? Comparative to just the index or the stock market in that category, over the same periods, being that it's got double the money in there that you're putting in, so you put in $1, you're relatively exposed to $2. We can see that over time, it performs relatively similar, right? Like it's substantially more than its counterparts. But this also happens on the downside. So you can see here, the orange one being the fund and the black one being the market. You can see that whenever the market's going great, it's always winning, right? But when the market's going bad, it also performs worse. So at every time there's a dip, that orange is lower. And look at this in 2020. In 2020, you can see that the S&P was at 21%, while this was at -8%, right? So you can, and you build up all this equity, but then all of a sudden on the downturn, you also lost all that equity and it's built. So over time, it definitely outperforms. But that's where the holding for long, because if you're not good with volatility, there's going to be periods where you're doing really well, and there's going to be periods when you're doing really bad. And that's the upside and downside of leverage, right? Because the borrowed monies have a cost involved, and if you've got double the money in there, well, then the return is going to be double on both ends, right? So positive double, negative double. And we can see that pictured here. So this happened with AMP around the GFC, where a lot of advisors, or a lot of, not just advisors, a lot of people were hearing about geared funds and were investing their money in these geared funds. All of their money. And they were stellar returns for years and years. But then the market turned. And all of a sudden everyone was panicking because they were down 50%. Oh, it's this whole ignorance about risk versus reward. Oh, I didn't know. You weren't complaining when you're getting 100% returns. Right? This is the paradoxical nature of risk versus reward. And then what happened? People were trying to sell out. And a lot of those funds got frozen because there wasn't enough money in there to cover the debt. So the company had to freeze the accounts to make sure that people could sell out as part of it. And that's a risky play, and that's why you've got to be cautious with how much. What we like to do for clients who are leveraging with internally geared portfolios is we like to just have a small allocation. We're just trying to chase, like you can see here, this is a 5% outperformance if you put all your money in there, versus if you have a slight allocation, like 2, 4, 6%, something like that. You're only trying to chase a half to 1% outperformance. And I'll show you why that's important soon. But that's dramatically reduce your risk. You don't want to leverage your entire portfolio. Well, you can. If your risk is up and you want to do that, sure, go for gold, but don't whinge when it bottoms out and goes through the floor. But it is a nice way to add a little bit of extras, you know. I wish, knowing this, I wish when I was 20, from 20 to 30, I wish I ran heavily leveraged portfolios across that period of time, because I had time to gain it back and had all that time there. So it is something that I wish I knew a bit more about. But as you get older, it's definitely something you want to dial back on. From a risk perspective, because there's no tax benefits for you inside that fund, especially inside your super, but the long-term effects of it being positive. You can see this over the last 10 years. We're talking a total return of 202% versus 135. So you're talking 70% more money at the end of that. But let's say the market dips this year, that could very quickly be back there. So it's also a timing issue, right? So that's the types of funds, that's the types of leverage that we're looking at. Now, people will ask me, well, what about debt recycling? Well, debt recycling is just a form of an investment loan. Okay, so debt recycling kind of has that middle ground where you're not margin lending, so you're not securing the shares against you're not securing the loan against the shares, but you're securing the loan against the property to buy shares, which theoretically brings down the risk because you've got a much larger asset that you're borrowing a small amount of to secure another asset with, versus property. If you're borrowing, you use your equity to borrow another property, you're taking that equity, which is debt. It's not just cash out. You're taking that equity, which turns into debt. You're putting that down as a deposit, and then you're getting more debt. So using debt as a deposit and then debt for the entire asset. So it's completely 100% debt, right? Whereas with the shares, we're taking that small percentage, 10%, whatever it is, and then we're securing just 10% of your property against shares, which are fully they're fully debted, but it's only a small LVR, like a small LVR or a small amount of equity against your property to do that. So it's only that mix of the two. There's no margin calls, nothing like that. So is a little bit more effective in that nature. All right, so let's have a look at some scenarios then. Oh, actually, before that, let's look at an example, right? So this is looking at BetaShares geared diversified portfolio. You'll see it's GHHF. Oh, it's changing. It's changing. Now, if we run it over a year, we can see that it's done 20.46%. Now, the same portfolio without gearing did 16%, right? So it's not, this one's leveraged a little bit lower than the other one we just looked at, but we can see 17% here, it's going up today. So we can see that, and there's a slight difference, right? 3%, but over the lifetime of someone's portfolio, that's a lot of money, right? That'll generate a lot of money. So I don't know if it'll have, let's have a look at maybe some downturns. All right, so let's look. So in the past 5 days, that's done negative 0.8%. Okay, there's a great example, right? So we can see that this portfolio is a negative 0.08% in the last 5 days. The geared portfolio has done negative 1.65%. Now, I know this sounds like negative 1.6, but it's a multiplication of that loss. That's what you got to look at. That's what's happening, because on a bigger scale, this could be detrimental, right? So that's the difference, right? Yeah, everyone wants to look at the positive side and go, oh my goodness, look how great it's performing. And it is, it's fantastic. But at the same token, on the other side, it's pretty monumental how much you can change. You've really got to factor it into your risk profile. You've really got to be able to have the balls to hodl, as the young crypto lovers would say. That's where the other leverage comes from. Like, you see all these people posting their crypto gains and stuff. And most of those portfolios or day trading accounts, it's mostly leverage, right? They're trying to buy something in a small window and 100 exit. And this is where you hear the term loan account. And that's where people will leverage up and their account will go to zero and they close it down and try and start again. It's gambling basically, right? It's not that they're making money on crypto and trading. They're just gambling. They're just leveraging hard. Most of them have no fucking idea what they're doing. Where this is more of a long-term approach. So slight excess allocations for that long term. All right, let's go do some scenarios. All right. Now, I'm not going to stay on here for too long today for questions because there's no one on here anyway. Either I am the goat at explaining this shit to you, or you're just not asking me questions, because at the end of each one, no one's flying through the questions, which I don't mind. It saves me time. But if you want to get answers, ask me shit. No, I don't know how many of you are watching this shit. All right. So we got the classic mine and Gemma scenario again. I'll close off some shit. Okay, so first, let's look at the difference between, let's say we're going to run at 8% growth on something, right? So let's just take our super, for example. And in this scenario, what do we got? So let's just show why, with the power of leverage, why if we run an 8% growth on both our portfolios, and we target usually 9% for most of our clients at our age. So let's take this, right? Let's then add in a second plan. So in this scenario, we're manually bastardizing the plan to say that we're leveraged our portfolio to get an extra 2%. That's it, right? So we've got a slight, you see that most of them over that leverage period is double or 30% extra. We're gonna have a small allocation to leverage to see what that changes. And I'm using super here as an example because it's long term, where most likely long term the portfolio perform. I'm not going to do a short term thing because in the short term we could also lose a lot more than the non-leveraged example. So just to see what the power of 2%, just 2% a year in returns can do. So if we take the comparative chart. Now, if we go to assets, the top one being leveraged, the bottom one not being leveraged, let's get rid of future money and let's put the legend up there. Let's remove everything. Let's add back in our super. Okay, so what's the difference of it? Well, by the time we accessed our money, from just an extra 2% a year, which is a lot. I don't know why we talk this down like 1%, 2%. This is why the cost of your super fund is so fucking important as well. In today's money, the difference of 2% per annum can mean if we're getting 8% net, 1.989 million combined versus getting 10% at 2.946. So just under $1 million. So if we start with, what are we starting with here? We're starting with $280,000. The difference of 2% a year by the time we hit 60 is a whopping $1 million difference. It's power of leverage, power of safe leverage, smart leverage. However, you got to remember what I said before was on the other side of that, it could also go backwards very hard, right? And you will have years like that. So you've got to make sure that your risk profile is adjusted. Let's look at what 1% will do. Well, it's about half that, but have a look. So same thing, same period of time, 1%. $500,000. Now, this is the risk versus reward trade-off. This isn't like just because you leverage doesn't mean you get an extra 2%. It could go bad, but this is the what you've got to set as an investor. Nothing's guaranteed. You've got to make calculated decisions based on what you can handle and what the numbers stack up to be. So if you're someone's like, you know what, that extra $1 million to try and take an extra 1 to 2% leverage makes sense, and you can handle the volatility, and you got 30 years, well then, yeah, if you commit to that. But don't be coming to me after this as a client and be like, I want to leverage my super, and then we have one rough year and you start crying to me like that. That's what happens, right? Let's not do that. You got to own this. This is part of the risk versus reward trade-off. The positive is if you can get that extra 1 to 2%, substantially better. But if it in bad years, you're going to be able to handle those bad years, right? So that's just simply if we were to use internally geared funds. I wouldn't recommend those for people under 50, over 50, sorry. But that's one way of looking at leverage. Now let's look at the difference of if we were to invest. So in this scenario, I am going to start an investment portfolio. Let's just use this. This is not real, but actually no. Let's keep that there. Try to share portfolio in.
Yeah. Okay.
What shares are you going to invest in, Ryan? I don't know. Just fucking work. Share portfolio, no debt. I'm going to say, let's put in all of our surplus. I'll figure out what that is. Let's say that's running at 9%. Cool. Let's start it from here. And let's just finish it when I die. Let's then go into our cash. And let's sweep all of that extra money. Joe, are you free? Can you try and take this call for me? I'm just trying to book in a thing. So you got access to my calendar?
Yeah. Hello.
Sorry about
that. No, I'm Jai.
Tell you my assistant.
Yeah.
All right. Sorry about that. Doctor's calling me. I've been trying to.
He's currently on a call. Are you looking to book in a meeting with him? Yeah, I can book in a meeting with you now.
All right.
Oh, medical. Oh, sorry. Yeah, I'll talk on the next one.
All right, so we've got this in here. We've got this in here. Let's look at what the balance looks like, right? So I'm going to get rid of this one for now. Oh, not that one. I'm just going to say, let's just use the longest time frame possible. So let's get rid of the parent time goal. Okay, so in this instance, all I've done is I have to drag this. Oh, sorry about the commentary. I'm shocked to those who are on a client or haven't dealt with me a lot, but I do this. So if we go in and we have a look, we can see that all we're doing here is we are putting all of our surplus money into debt. Into share portfolio. Okay. So if I have a look at our investments, I go to that's where the debt finishes. We are investing 67,000 a year into our share portfolio, slowly increasing. If I then come back just quickly, just to make it easy for this, and I say, let's get rid of paying off the debt. Let's not pay off that mortgage. Fuck the mortgage. Fuck the mortgage. Oh man, I'm hungry. Huh? Always got a fight coming up. Oh, Jack. I don't know why you get Jack to fight. I'm getting lean. All right. So my brain's going. All right. So if we invest all in there, what we're looking at here is how much are we putting into shares? That's all we want to know. First year's 13,000. As we pay off the debt, it gets more. Great. So what this is telling us is that's the low risk number that we're doing. 27, all those numbers, right? So what we're going to do when we're doing debt is each year we're kind of going, well, let's say I wanted to borrow money to invest in debt in the share portfolio. If I can afford 13,000, well, technically speaking, that means I could afford, if I've got an interest only debt, I can only, if I'm doing it with cash, I can only invest that 13,000. But let's take a buffer off. Let's say I go, okay, well, say put $3,000 aside as a buffer, and I've got $10,000 capacity outside of my mortgage. Well, that means that $10,000 divided by, let's say, 7%. I could afford to service $140,000 of investment. Right? So that 6% loan, I could secure $150,000 against my home and invest that and only pay the $10,000. Again, going back to when we're controlling an asset, well, what makes more sense? The other part is that $10,000 is tax deductible. So it's really only about 6 or 7,000. Versus if I'm putting the 13,000 cash, well, I'm investing 13,000, but I've actually got to earn 16,000 to pay the tax amount to then invest that. See what I'm getting at? This is the power of debt. So what's really riskier? Controlling $140,000 a year in debt that can then grow, and only paying 6,000, or just earning 16,000 to then invest 13,000. It's risk versus reward, right? So if I then said, okay, well, let's make up a second scenario. In this example, by the time I am 60, get rid of all that shit. Just look at the shares. In this scenario, by the time I'm 60, I'd have 1.79 million in that share portfolio. Doesn't to compare. I'm not going to do property today, by the way. It's ridiculous on Nick. You just keep adding fucking debt and going up. We did this last week, so we're just going to use debt against shares as an example here. All right. So let's say that Remember I said we can support, in the first year, we can support $140,000 worth of interest costs on the debt. But let's be really conservative and make the cash flow even better. And say what we're going to do is we are going to, this is debt recycling, but I'm just going to do it from a simply, like you'd be stupid not to. You'd be stupid just to take out debt and not pay it anymore. So we're just going to do it properly. So let's say, all right, I'm going to service my mortgage. I'm going to pay it down first, but as I'm paying it down, I'm going to draw down the debt. I'm going to draw out the debt and I'm going to invest with the debt. All right, then what I'm going to do is I'm going to take a investment loan. Remember, we can service $140,000 and then probably increase it. We're not going to do that straight away because that's a bit crazy. So what we're going to do is we are going to say investment loan. We are going to make it credit limit. Let's give us $1 million. Yeah, fuck it. We've probably realistically probably got 400,000 we're allowed to use. But we just, as the equity grows in the property, we increase that. So let's run it really high at 7%. And let's make it interest only. And yes, it is tax deductible. We're going to start that from day one. And we're going to stop at 60. Oop. Now, are we allowed to withdraw from it? Yes, we're going to say scheduled only. We are then going to plan our withdrawals. And each year, remember I said we can service 140? Well, we're going to build that up slowly. So we're going to say investment drawing, investment contribution. How much? 25,000. So we're going to draw down. We're going to pay out all our surplus money onto the mortgage, and we're going to draw $25,000 a year. And it's going to happen every year from now until we retire. Done. Now let's suss that bastard out. So the extra, boom, right? So what does this look like comparatively? Well, by the time we're 60, the exact same scenario. Let's go to assets. Let's hide everything. Hide it all. Boom. I don't know why. Oh, that's right. Sorry, I've done this wrong. So it's even better than that, but let's go back. Let's go to our Shovel Follow and let's add $25,000 a year because that's what's going to happen for the debt. Let's try that again. Right. No one's on, so there's not going to be any questions. So I'm going to finish up after this. But this is a really nice way to show it. Yeah. All right. So let's look. By the time we are 60, by using the debt, the exact same sort of scenario, we have an extra $500,000 in assets. Same scenario, same money, same cash flow, no different. But something else we got to factor in. Our debt, we also have $292,000 worth of debt. But what else can you see on here? Well, we've got more assets, which means the growth on those assets by 60 if we wanted to maintain them or more, because we're controlling 2.something million versus 1.7 million. So if they just do the same percentage each year, then we're getting an extra, let's say it's 10%, we're getting an extra $12,000 a year in growth. Just because we're controlling
It's how we'd look at the bag, mate. Like
we have more debt because we're holding it interest only, which we would repay it at some point. But look at this one. We've also paid off our home substantially faster. Substantially faster. We would still have debt till 57 here. In this scenario where we're paying the money off and then drawing the equity to invest, we run out of debt at 45. We've got more money, paid off debt faster. Now let's go to one more thing. What about taxes? First year, same. Second year, 1,500 better off. And repeat that through, right? So over that same period, I've been relatively conservative here. Over that same period of time, now this is bigger because we've got a bigger portfolio, right? Over that same period of time, we have paid almost $100,000 less in tax. So let's put the scenarios together. We paid almost $100,000 less in tax. We reduced our debt 10 years faster, like completely cleared our home loan 10 years faster. And we had over $500,000 more at the end of the period. And it wasn't like we weren't tilting ourselves to the hills. We were just doing this strategically, right? If in bad years, we could still sustain those small interest rate repayments. What about the net worth? By the time we die, we'll be $2 million better off. That's the won't make that much of a difference. But what about if we used inflation in it? So by the time we were 60, we're just shy of 500,000 better off from a net worth position, right? But if we look at that and you think about those little things, like that's, you might look at it and go, you might look at it and think, oh, it's only 200,000. But you reckon when you're 60, you wouldn't be stoked with an extra 250K? Of course you fucking would. You're telling me you wouldn't want to pay off your home faster, have more money, and pay less tax. Again, not over leveraging. All I've done is restructure the money here. Like the cash flow is the exact same. I've restructured the exact cash flow to then accommodate this in a safe manner. That's the power of what good leverage and using debt for wealth is. Where people go wrong is fully tilting themselves, right? Like just taking in multiple properties, maxing out the capacity every year. And it's great when it's great, but then it's not. You have a child, one partner goes on maternity leave, you lose your job, you get injured, the market shits itself. That's when you're fucked. That's when you've got real dramas, right? So, like I said at the start, debt is the tool of the wealthy. But there is also, it's like what I say to people in the meeting, it's a strategy to a strategy. You can't just watch all these people on social media who have got multi-million-dollar companies funding all of this debt. And they're like, yeah, leverage is great, debt. When you're a two-income household, under $300,000 a year, like you've got capacity. There's only a certain amount of capacity you can do. And if you to increase that capacity if something goes bad, then you can't push yourself beyond that limit. So in summary, debt is a great tool for wealth when used safely, when used in a strategic manner. I would argue that it could be riskier for some people not to use any debt at all than using a safe amount of debt. The real question is, what is that safe amount of debt? And that's what we can help with. That's how we get through that. There's no one on, so there's no questions, but in the comments, all that stuff like usual, please feel free. I really enjoyed this session. I think it was quite informative. A lot of you voted on it, so I'd like to see some comments. And also, don't forget to vote about my goal too. Should I get it or not? Have to. All right. I'm off to the next meeting. I hope that was good for everyone who gets it. If not, please reach out. We can talk about this more. Chat soon. See you next week.